Hey everyone, welcome back to Accounting Basics. Today we're diving into a crucial topic in accounting that often flies under the radar, the assessment of going concern. This is one of the basic accounting principles that affects how financial statements are prepared and interpreted. So let's break it down into simple terms. In accounting, the going concern assumption means we assume a business will continue to operate for the foreseeable future, usually at least 12 months from the date of the financial statements. This assumption underpins the way we value assets, record liabilities, and present financial results. It basically says this company isn't planning to shut down anytime soon. Imagine you're looking at a company's balance sheet. If we believe the business will keep running, we record assets like buildings or inventory at their original cost or market value, not at the price we'd get if we had to sell them quickly. But what happens if that business is on the verge of bankruptcy? That changes everything. The assessment of going concern is an accounting process where management and often auditors evaluate whether the business can stay afloat in the near future. If there are any serious doubts about the company's ability to survive, this must be disclosed in the financial statements. Why? Because investors, lenders, and stakeholders need to know the risks. For example, let's say a retail company is facing massive losses, can't pay suppliers, and has defaulted on loans. The accountant or auditor would need to ask, can this business realistically recover? Or is it at risk of shutting down within a year? If the answer is yes, there is a going concern issue, and this triggers a different approach to financial reporting. Let's go over some of the common indicators that a company may not be a going concern. Recurring operating losses, negative cash flow from operations, loan defaults or inability to raise new financing, legal challenges that threaten operations, dependence on a single customer or supplier who is no longer reliable. Accountants also look at management's plans to turn things around, like cutting costs, restructuring debt, or raising new capital. If there's significant doubt about going concern, but management has a realistic plan to fix things, that needs to be clearly disclosed in the notes to the financial statements. But if there's no viable recovery plan, the financial statements might need to be prepared on a different basis, often called the liquidation basis of accounting. Auditors also have a responsibility to evaluate going concern. If they believe there's material uncertainty, they'll include a special paragraph in their audit report. This is a red flag for lenders and investors. Let's recap the key points. Going concern is the assumption that a business will continue operating. Assessment involves looking at financial health, operational risks, and management's plans. If there are doubts, disclosure is required, and the accounting approach may change. Auditors highlight these issues in their reports, which can impact business decisions. And that's your introduction to the assessment of going concern in accounting. It's a concept that sounds simple, but has huge implications for financial reporting and decision-making. If you found this helpful, hit like and subscribe and let us know in the comments what you think of the going concern principle. Thanks for watching.